All right. Well, good morning, everyone. This is JJ Risha with Pismo Ventures. I have Stephen, as usual, with me today. He is the power behind everything we've been doing at the competition. Um, Today we have KPMG with us, Ryan, Zach, and John. They will be presenting. The subject is accounting and finance considerations for startups. So I will give them the floor in a second, but first I'm going to kind of give you an update on the competition. Yesterday we canceled an event we had, which is the live judging event for hardware and software technology, and that was because of me. We had, or Irvine, we had a fire. We were literally packing like crazy, and we evacuated. It was mandatory evacuation. So other than that, we were back home by maybe 10 p.m., where there was no traffic and everything was kind of back to normal. So we're good to go today. So we're back to normal schedule. The event that was on yesterday, which is a hardware software technology live judging, has moved to Wednesday next week, Wednesday the 4th next week at 12 noon, which is normal time we've been doing these live judging events. Um, Competition wise, just an update. So this is the third week of round two. I guess it would have been done this week, but because of rescheduling, the round two will be done on the 4th next week. We have two more judging panels going on, or categories. So it is AI, robotics, and blockchains. Is today at noon, so you can all join us as well. You're all pre-registered to join. And then on Thursday we have the digital solutions panel. After we're done with round two, which is this week and Wednesday next week, we will announce the winners for those three panels, or those three categories, and then we will go into round three. So round three is really the final round for the competition, and it's split into two events because the winners of each of the categories will go and pitch 12-minute pitch and 12-minute Q&A to the judges. But because we're going to have 8 companies, potentially maybe some wild cards for having 10 companies, and because they're pitching 12 minutes and then Q&A 12 minutes, we're splitting the final event, or the final judging, into 2 days. One on the 12th of November, and the other one is on the 17th of November. So stay tuned. Also, we still have a lot of webinars, not just few, still have a lot of webinars. So you can always go on the website, ventureplancompetition.com, and then you can take a look at the timeline and also the event calendar, where you have all the events with all the links. So everyone who's registered for the competition has full access to all events. All right, I think that's it. We do have a virtual networking lounge right after this. So if you guys want to stick around, the link is in the chat. We will post it again one more time before we're done. But also you need the password for that. So you need the link to go to the virtual lounge. And then the password is KPMG-2020-VIP. So please make sure you grab the link and the password as well. Ryan, Zach, and John, welcome. Thank you for being here today. Please introduce yourself and take it. It's all yours.
Yeah, awesome. Thanks so much for the invite. Glad to be part of the community and what you guys are doing. We'll definitely try and make this as interactive as we can, because accounting by nature is not the most entertaining topic. But trust me, we will make it cool. So yeah, so myself, my name is Zach Olson. I am the founder and CEO of a company called Bookly, which was acquired by KPMG about 2 years ago. Now we're KPMG Spark. Today I'm still with the firm post-acquisition. And yeah, I think, I was slated to introduce everybody, but I always feel it's best for everybody to kind of give their own backstory and background, and we'll do a little Brady Bunch session here. But Ryan, if you want to introduce yourself and give some background, that would be awesome.
Thanks, Zach. So hi, everybody. Ryan Youhan. I lead the business development efforts for KPMG's emerging growth practice in Southern California. I spend most of my time in Los Angeles and Orange County. I know JJ through Tech Coast Angels and various other opportunities just to get some branding in the marketplace. So when an opportunity like this came up to sponsor such an awesome event, we immediately jumped on it. So glad to be with everybody today and glad to participate in this great competition. John?
Hey everyone, John Walker. Apologies in advance if my internet is a little glitchy. We have some work being done to the home and everything's just kind of chaotic. But with that being said, I head up strategy and business development for KPMG Spark. And when Ryan brought this opportunity, to Zach and I saying, hey, he was getting involved in this community. Of course, Zach and I naturally jumped at this opportunity. Like I said, my previous background was venture capital. I did that for about 10 years, focused on the seed and early stage type deals, and then jumped to the operating side of the fence. So I've done a few different startups, and as Zach said, accounting and finance, when doing startups is definitely not the exciting thing you want to focus on, but you've learned after doing this a few times that it is actually quite important and necessary, whether it be to go raise your next round of financing or, in trying to, figure out what your KPIs are and things like that. So anyways, long-winded intro, but excited to be here. And like I said, any chance to hang out with entrepreneurs, we're all about that. So nice to be here.
Absolutely. Cool. Thanks, guys. Yeah, I think maybe to kick things off, we'll give a little more context as far as, KPMG Spark, our story. And, really what's interesting about this is historically a firm like KPMG has always worked with larger corporations and entities all over the world. So, working with the startup community, the firm recognizes how vital that is to the economy, to the world, and, really backing innovation and disruption in the real world scenario. And, that's what's really cool of their vision, really colliding with, the vision that we created at Bookly and Spark, and, really bringing that to the market and working a lot closer with, professionals like Ryan and Pismo. So anyway, let me give you guys a little more context. So if it's not obvious by now, I'm not an accountant. I'm not a CPA. So this is what makes our journey maybe a little more interesting than others, especially because we are acquired by a big four. So I started Bookly in 2013. And the context there is I'm a serial entrepreneur. I've just started a handful of companies. And, the one consistent theme is, nobody in their right mind starts a business, a startup, or any other business for that matter, to try and become an accountant or a bookkeeper. So, throughout my journey, one of the first businesses I started was actually a skate shop. I've been a skateboarder my whole life, but realized, I'm probably not going to be the next pro. After I broke some bones and dislocated some others. So the next best thing for me was actually starting a business in that industry, which happened to be a skate shop. And this was, when I was 23, this is like 2005, but quickly found out the pain points of accounting that every other business runs into inevitably. So from that perspective, I really took the pain point, and I think that this is what most entrepreneurs have in common is they're focusing on pain points that they've experienced, and then, trying to reimagine that and reinvent the way things are done. And that's really, for me, my journey. It just happened to be accounting and trying to help other small business owners and other entrepreneurs really enjoy the journey. So fast forwarding, yeah, I bootstrapped the company for about the first year, started getting traction, and then yeah, at that point was introduced to the venture community, which was a new adventure to me because I had always self-funded, the other businesses. So in 2013, we raised our first micro seed round, if you will. Kept growing the company, gaining more traction, and then fast forwarding to 2015, closed our first official actual seed round. Um, and this was an exciting point in the company. This is about when John joined the team. So he has a lot of the war stories under his belt. Um, and, really the focus there was, how do we take technology and completely reimagine and reinvent the way businesses experience accounting? And, one of the biggest pain points is as a business owner, you face, really two options. One, you can either go out and hire, maybe a local accountant or your mom potentially to handle the accounting, the bookkeeping, or you can try and do it yourself. And both of those really have opportunity costs associated with them. And that's what really became obvious and what we wanted to solve, because you can either take the time, to try and figure out how to do accounting on your own. If you're lucky, maybe you took an accounting course or two in college. And other than that, you really the onus is on you, right? As the founder, to understand accounting methods and principles. And as a business owner, that's what you have to learn those important delegation points. And that's really where we came into the picture. Is okay, we started building out our own proprietary bookkeeping technology as the foundation of the business, because with that data, it powers essentially everything else that you need to really understand where the business is going. And to John's earlier point about KPIs, being able to understand, what is driving the business. And we'll get into that a little bit later on in more detail. But this is really the foundation of every startup, is the data, and the bookkeeping powers that data. So in 2015, we actually released the first version of the technology, and started really, getting, that product market fit and scaling. And this became really exciting because finally at this point, we were able to start delivering what we call real-time bookkeeping. So essentially with our platform, every client we work with, they can connect their banks, their credit cards, all the data flows in. We have some pretty awesome machine learning on the back end that's categorizing and doing things in real time. But, from a business owner perspective, being able to have access to your data when and where you need it is really crucial to make decisions to help you optimize how you're operating. But being able to scale across the US, we actually started to scale into Canada as well prior to the acquisition. So anyway, this is a really long-winded kind of intro to who we are, what we do, and there's a lot more to the story. But being part of KPMG now, so we were acquired back in 2018. And, it was really interesting because when I first started the company, it was really to disrupt accounting firms like KPMG. It was really to change the industry as a whole. But as we got into the process of having conversations and talking, we quickly realized, gosh, we actually have more in common than not. And KPMG actually understood what we were trying to do and how we were trying to innovate the industry. So what's really powerful about this whole concept of KPMG and KPMG Spark together now is, really the concept of being able to work with companies or help founders really from idea all the way through IPO. And that's really never been that's never been a capability before in the accounting industry. So that's, obviously what, the next leg of our journey post acquisition is. Before acquisition, it was building an accounting service for small business owners like myself. Post acquisition, it's about building an accounting service that supports and props up other tech founders. So being a venture backed company, how can we help them in their leg of the journey and reaching their goals and aspirations. But anyway, again, a very long-winded intro, but hopefully that gives you a little more context of kind of the mission and focus that we have here. And, there's a lot of hard parts about being a founder, and we just want to be part of, as many startup journeys as we can, and helping people enjoy the journey and, really find the path that they need to be on. So anyway, with that, I'll kick it over to Ryan and John. And if you guys want to layer on to any of that, definitely welcome it. So.
Yeah, no, I appreciate you doing that, Zach. I think the thing you said that has always resonated, I think, with me and I think with other entrepreneurs we talk to on a daily basis is that whole idea to IPO. And again, not knowing the DNA of everyone on this call right now, but I imagine, there's a lot of entrepreneurs on this call. And I think, as all of you go through your journey, I think one of the biggest things you'll find is, as Zach mentioned, having done starts myself, it's like a lot of times, like, you'll start doing the books yourself or a family member doing the books. But then when you raise that round of financing, your investors may have a recommendation on who you should use, or maybe it's like an outsourced CFO or things like that. And so kind of on every leg of your journey, you're kind of having to hit reset on your books and kind of get things cleaned up, and things are done in the format of whoever, kind of the new accounting solution is that you bring on. And so again, what we, like I said, that whole idea to IPO, that's one of the things that, if you remember anything from, the webinar today, that's one of the things I would have you remember or encourage you to remember is that whole idea to IPO of, no matter what leg you are on your journey, you can never outgrow KPMG. And we'll get into it here in just a little bit, but whatever needs you may have as a startup or, as you raise funding, we're here to help with that. So again, not meaning to pile on too much, but again, if you could remember, a few things from this, one of them I would encourage you to remember though is the idea to IPO. No matter what stage you're at, we can definitely help you out because it's something we understand. So.
All right, efficient accounting for startups.
Cool. Yeah. So like I said, we were just touching on, when you, start a company, like I said, as Zach said, no one's starting a company to become a bookkeeper. You're starting something because it's a labor of love. You see there's a need in the marketplace. And so your focus, rightfully so should be on, how do we grow this, and, to Ryan's point, it's about top line growth should be the focus. But eventually, as you mature as a company, and a lot of times it doesn't take that long to mature as a company. As soon as you get that first paying customer, like you're there, you have to start getting a foundation in place. Because if that foundation is in place, the more you grow, of course, the harder it is to catch up and get that in place, as your journey progresses.
Yeah,
So
a big part too, and John and Ryan, and I'm sure a lot of people listening already know that, delegation is probably one of the hardest aspects of being a founder. And especially when you like to, make sure the quality is there behind every aspect of your company and what you're doing. You're building a brand, and, you really have to keep your finger on the pulse of the business at all times. And, the back office functionality is like, definitely a crucial aspect of being successful. But this is one area that I certainly struggled with. And every founder I talk to or mentor or just have conversations, delegation is absolutely one of those things, because, you're growing a baby and you're taking care of it. But at some point in time, you do have to make sure that, you're building a stronger team around you that's, the team is greater than just one. And accounting or the back office in general is definitely one of those crucial areas. So, you definitely can't be afraid to take those steps, but make sure you're doing it, strategically for sure. Bookkeeping. And like I had said earlier, this is kind of the foundation, right, of the business itself. Um, Understanding the money coming in and more importantly, the money going out is really crucial to the success. And especially if you are raising venture dollars, understanding your runway, your burn rate, um, you know, I can't even tell you how important or emphasize how important it is for you to be a good steward of the bookkeeping process behind your company. And in most circumstances, there is more money going out, especially in the early days, than there is coming in. If you're still trying to find, product market fit and all those crucial aspects of your business, or if you're going through the manufacturing process and dealing with hardware, those are, so many other dynamics that go into it. But without a well thought out bookkeeping system in place, it's virtually impossible. Or if you do have some kind of rudimentary bookkeeping, you have to give yourself as large of a strategic advantage as possible in being a startup. And if you don't have essentially real-time access to the data in your startup, you're just stacking the cards against yourself, which can be done really easily, especially when there's, if you just are coming fresh off of a fundraising round, the bank is flush with cash. It's easy to get blinded by that, and it's easy to spend that money. So, and which, as the founder, it's your job, right, to deploy that capital, but more importantly, to deploy it strategically and responsibly. And if you don't have real-time access to where that money's going and what's providing the best ROI for growth, those are dangerous aspects. So it is important. And John and Ryan, I don't know if you guys have additional thoughts on that, but that's kind of like my initial knee reaction to the thought around bookkeeping for
Yeah.
startups.
No, I think you're exactly right. I mean, goes without saying, it's bookkeeping definitely is not fun. I mean, if we get candid, it's a necessary evil. But at the end of the day, and Zach hit the nail on the head. It's something we learned, and one of the reasons why Zach created this solution was the importance of real-time information. I mean, as a startup, I mean, you're moving, you're going super fast. You don't have, time to, wait 30 days to get kind of, hey, month end, how did everything work out? And so again, one of the reasons why, Bookly, or now Spark, was created was so at any given point, a business owner could log in and see, hey, this is the health of my company. This is where I'm at right now, to help them make, better real-time decisions. And that's the thing. It's funny, a lot of times, when we were going, and Zach touched on it, going through, the fundraising process, and investors were investing, and they're saying, well, why bookkeeping? It's, hey, there's a lot of companies out there that are, focused on sales tax or other elements. But at the end of the day, bookkeeping truly is the lifeblood of any company. And if you understand what's going on in your books, you can better make decisions on everything else. And again, it sounds so simple, but again, it's as Zach said, it's so easy when you get money in the bank to then start making decisions and not keep an eye on this. And all of a sudden, before you know it, you're like, uh-oh, like I'm running out of money. Like, do my KPIs match where they need to be? Can I go raise more money? And so again, it's just can't emphasize enough. Like, again, it's not fun, but it is critical and essential, to have a good bookkeeping foundation in place.
Absolutely.
All right. So next we'll move into just one of the opportunities we wanted to talk about, which is R&D credits.
Awesome. Yeah, R&D is, man, from just talking from personal experience with the R&D credit, um, it is one of the, I don't know, areas of tax I think most startups overlook. And John and Ryan, feel free to weigh in throughout this, but you know, I, again, just from personal experience, um, during the acquisition, this is actually a tax benefit that we were able as a startup to come back to, and actually leverage to help reduce our overall liability when it came to the acquisition outcome. So it's really interesting, right? I mean, most startups, tech startups, have some degree of eligibility for R&D credit. And, this really comes to play when you're, investing real money into an engineering team and, really developing something that hasn't existed before. And what was really insightful to me is the R&D credit just didn't apply to, the engineers that we hired, but it also applied to the supporting staff that would, gather feedback and, document bugs and other issues and feature requests, everything that went into actually building and developing a new technology that was part of our platform. So, I mean, it's definitely a real world benefit that startups can take advantage of. And, you know, if you're not tracking it, I mean, that's again, it goes back to the foundation, I think, of this conversation, which is making sure that the record keeping is in place. Because if you're not documenting, the ins and outs of how much team members are getting paid through wages or contractors, really documenting all the supplies and equipment that you're purchasing, laptops, computers, servers, or, again, leasing any of that equipment as well. All of that adds up. And at the end of the day, that equates to adding real dollars back in your startup's pocket, and hopefully extending the runway. And I think that that's what most startups don't recognize is, gosh, we're not profitable, we're not making money. How could we even possibly get a refund? But the R&D credit is actually a real way of doing that. And in a lot of scenarios, depending on your payroll count, head count, I mean, it can add up to hundreds of thousands of dollars. So, and again, everybody's situation is different, and there's a lot of, factors that go into it. But post-acquisition, this is actually something that we've started offering heavily for a lot of the startups that we work with, just because of the real benefit that, we saw, firsthand experience. But anyway, that's kind of my tangent on R&D credit. But Ryan, I don't know if you want to layer on that and what you've seen in your experience.
Yeah, I wanted to flip through just to give a little bit more info on the mechanics over the next few slides. So, and I believe that we'll be able to share this presentation with everybody after we're done. But we wanted to just cover off on, again, some of the details of what you can look for, what qualifies. But to Zach's point, a lot of what you're putting into your business will qualify for credits. And one thing that to keep in mind is, even if you're using some offshore resources, the cost of having somebody manage resources offshore can qualify some of the expenses as well, which was surprising to me. But again, it's something where the government wants you to be able to take advantage of this program. And again, if you take a look here, there's a ton of different expenses that would qualify. And I'm sure that everybody on this call who's got a startup, particularly those that are tech related, are going to be able to access something that's on this list.
Absolutely.
So what qualifies, again, this is the initial R&D credit for companies that are doing under 5 million in revenue. A lot of people, when they think about R&D credits, they think of larger companies that are accessing a larger pool of money. But for smaller companies, again, I mean, a credit on your payroll up to 250K of your payroll taxes could be a nice chunk to be able to put back into the business.
Yeah, that's a nice angel round right there.
So that's, again, what would qualify. And again, we're assuming that most of the folks that are on this call are going to qualify there. Again, more on the, what type of expenses. So again, wages and salaries, to what Zach was talking about, plus, contractors, if you're bringing them in, any of the supplies that you're using, leasing of equipment. A lot of folks have to go out and get some equipment in. And then a little 4-part test that you can quickly run through. We also have a handout that we can provide after the event that will kind of succinctly describe what we have here, but then also give you a little bit more information. And we don't want to make this a commercial for KPMG Spark, but that we do have a service that we offer that automates this process and makes it a lot easier than it had been in the past. So
Definitely.
I think that was perfect. I think, again, to Ryan's point, no one needs to take copious notes. Like, we can share the presentation, at the end. And like I said, we definitely don't want to turn this into like an accounting 101 class where if it was like me, I checked out of that and ended up with a C-, but now I work for an accounting firm. So again, it worked out. But again, for the purpose of this presentation, again, we want the focus to be on, you, the entrepreneur. And so again, with some of this stuff, the information's in the deck, we'll share it afterwards, but, we'll continue to move through this presentation, like I said, hopefully get to, some of your questions and things like that. And then some of this more, in-depth stuff we'll share later. So,
yeah.
Yep.
I think the repetitive theme is really like having a strong foundation for your startup from a back office perspective, from an accounting perspective. And, the compounding reason, starts to, where we layer on, the R&D credit, because again, taking advantage of that before you're profitable, before you're really generating revenue, all of these things are crucial. So, and we'll just keep layering on, the other strategic advantages from an accounting perspective that will help, really, what we want to do is, how do we, just stack the odds in your favor as a startup, and accounting can certainly do that. So.
Yep. Totally agree, Zach. The next topic we wanted to briefly touch on was 409A valuations. And again, this is all about giving some confidence, not only to yourself, but also to the folks that are, additional stakeholders, investors in your company. Zach, if you want to touch on this one, or John.
Yeah, yeah, 409s. This is one of those things that, it was like a baptism by fire as a first-time venture-backed startup founder, not even knowing what I had to do. And 409As was certainly one of those things that it was a surprise to me, after we raised that first round of funding, and then starting to divvy out options to team members. And, that's a real strategic thing as a founder. It's very commonplace and expected in the marketplace. And, at the end of the day, to Ryan's point, it's giving confidence to everybody around the table, all of the stakeholders. And it's not just your investors, but it's your team members, your employees, and having these valuations done consistently so they can understand and really be part of that bigger picture of the company. This certainly is checking those compliance boxes, but it goes deeper beyond just compliance from a tax perspective. And the confidence, I'd say, and John, it'd be cool to get your perspective on the confidence part of the team around stock options and everything. But, everybody, when they feel like there's skin in the game, it really can give you a strategic competitive advantage in the marketplace. But I don't know, John, if you have any other thoughts on that from your experience. And
No, I think you're totally right. And like I said, I think, when Zach did this and, when I came on, I mean, it was very strategic and it worked out very well again. And it's, making sure that everyone's invested in the outcome and in the end game. I mean, and it's one of those things that, it's everyone can cross the finish line at the same time. And when you cross that finish line, everyone knows, there's a reward to be had. And so, stock options, of course, can be, a very, very valuable thing, not only for recruiting, key talent, but again, getting the buy-in of employees. And, this is something I could probably, ramble on about for a long time, because I definitely have thoughts around, when hiring employees, kind of looking for signs of what's more interesting to them, the cash or the equity, and, being able to decipher that of, if they might be the right team member. As a startup, a lot of times, options is one of your best format of currency. So again, just being, smart with it, but at the same time, just it helps you hire the right people.
Absolutely.
All right, so we've got some boring details on the next few slides on 409As, but we just wanted to give you kind of a flavor of what some of the examples look like and what some of the calculation methods look like, just so that you can understand. I wanted to focus on this next slide though, getting back to what Zach and John were talking about the importance of 409As and raising money. Again, there's various techniques that you can use, and there's service providers that are out there that kind of help automate this process and make it easier. KPMG has a more long-winded, thorough process as companies kind of progress through their life cycle, where we get involved and again have more of a kind of a thorough run at this valuation process. But it's definitely critical. I think if you're whether you're raising a debt round or if you're actually going to have some investors come in and put some equity in, it's just an important part of the process. So even if it is tedious, and you think about it as just checking a box, but it's a critical data point that anybody who's getting involved, even if they're employees that you're bringing on, to John's point, and you're going to be issuing them options, I think having this data point is truly critical.
Absolutely. Yeah, it's definitely like an area I think a lot of founders aren't aware of in the beginning, unless they've done it before. But it is, something you have to stay consistent with. Once you start the 409A valuation process, typically every year, that's something that you should stay on top of as a founder. And it's easy to do. Obviously, if you're bringing on new team members, the company's growing, you're doing subsequent rounds of funding or financing, but definitely a foundational piece to the accounting side, to the back office of running a startup. So bookkeeping, R&D credits, 409As, all critical pieces to how you build your company.
So a little bit about just how the valuations would work themselves. Two of the most common ones that you'll see is the income approach, right, where you're discounting future cash flows and estimating the value that way. As a finance major, I definitely don't want to bore you guys with that process, but it's definitely been shown to be accurate and something that investors will look to for sure. They want to see, are you on the right track? Are you raising money? And then, what kind of value can you tie to that? Market approach is one, anybody who's invested in real estate, right? I mean, you're taking comparable assets and comparing them, applying some factors and kind of coming up with a value. So I think you'll see that a lot with industries that are on fire, right? Where investors want to get in. FOMO is real, right? Fear of missing out is real, and you'll see people trying to get in on a certain industry or a certain market, and they'll see valuations start to climb, and similarly your valuation is gonna do the same. So striking while the iron is hot is critical in that sense. So Zach and John, I don't know if you guys can talk to how hot the market was for accounting startups when you guys were in the process of the sale. But any thoughts on just like
Totally.
this market approach?
Yeah, I mean, market approach, I'd say, for early stage, right? Early stage seems, much more common, obviously if you're pre-revenue, if you're still in development phase, MVP phase or beta, it's definitely a more common approach. But as you're scaling and, let's say we're at A, B, or C round of financing, the income approach, definitely seems to be more commonplace. But yeah, there's a time and a place, and you have to be strategic in what you're doing. But at least from my experience, yeah, hopefully that makes sense.
Yeah. All right, and then just a couple of the equity approaches. So simple is just focused on one asset class, basically just taking the total number of equity, the total value of the equity and dividing it by the shares, right? And then you get a share price. So that's one method. And then complex is for companies that are a little bit further down the road, and you'll have multiple equity classes. So again, 409A is I guess rounding it kind of back out is just it's a critical data point. It's something that you're going to need along the way. You'll see it with companies. I think as they're raising around, it's something that becomes necessary. And for just good governance, you probably want to do it about once a year. So,
Absolutely.
All right. So that's again some of the mechanics and some of the calculations to keep in mind. Now we wanted to switch gears a little bit and talk about just financials and what to keep in mind as you're going through and putting your financials together. So we wanted to start with just kind of, what the options were for investment. Obviously, everybody on this call has an idea of kind of where they are, how they've been raising money to date. But one larger theme that we've talked about and what Zach was focused on earlier was just the idea that kind of KPMG's acquisition of Bookly to start was strategic in nature, in that you could literally take companies from this idea phase, MVP phase, right, as they're growing and getting some traction. Now suddenly, you do need proper bookkeeping. Well, it's like, what comes next? So by KPMG kind of folding Spark into our offerings, we truly can kind of span the life cycle of a company. And by that, we're talking about, hey, you're starting out your company and you're going all the way to a potential IPO and becoming a public company. So strategically, that made sense. And I say that to kind of take a step back, not to, again, pitch KPMG Spark or KPMG as a service. What I'm saying is that, strategically, if you look at companies that are having some conversations or considering, bringing you guys on as a strategic acquisition, there is something to be said for your company or your service or your product kind of helping them close a loop and or kind of extend what that loop looks like in terms of how they can provide services to their customers. So just as you're kind of going through and your product is coming along, that is something to keep in mind, that yes, there are different kind of exits and paths that you can take. Go ahead, Zach.
Oh yeah, one thing to layer on, I mean, just from experience is, what most founders don't realize is through the growth, kind of looking at the life cycle, right, of these are the funding life cycle of most businesses. Almost at each one or every other one, it's really interesting because you'll actually end up outgrowing most back office services or accounting services. And, that's the natural life cycle of growing a company. But that can also, you have to be cognizant of it because it can also be a great disadvantage, meaning that if we're in a race and we're passing a baton, certain people can run faster than others in the sense of the capabilities of their understanding of the tax implications of running a startup, or, a certain strategy behind tracking an R&D credit or reporting it, or staying on top of 409As or other complex tax issues that come from the foundation. In that bootstrapper, kind of accelerator era of a startup, you need to establish a strong foundation that you can build and grow on, because that's what enables all these other strategies or tools, per se, from an accounting perspective. So that's just, a quick thought to interject is, really think through strategically, how do you minimize how many handoffs you have to take during a race? Because that's going to give you the strategic advantage. Maybe that's just my analogy for startup accounting.
I love it, Zach. What I wanted to do here was pause for a second, make sure we're interacting with everybody that is online. So JJ and Steven, I'm not sure if there's any questions that have come in, or if anybody at this time wanted to jump in and ask any questions before we move into some more of the content.
Yeah, there are 4 questions. If you hovered over the Zoom window, you'll and then go down to it says Q&A, and you click on it, it says 4, and you can read them.
Okay.
Can you do that? Do you see that at least?
Yep.
Okay. So there are 4 questions in
Okay.
there. You can take it from the top and
Okay. So the first question is from Deep Blue Ghosh. Is it okay to capitalize product development cost for a patented product?
Yeah, it's a pretty technical question for sure.
I mean, we could get an answer for sure. I mean, off the top of my head, I'm not sure on that one, but I mean, we could definitely ask and get an answer.
Yeah, I think if for all the technical questions, we can certainly circle back and get a specific answer. That way we're, being thorough and accurate.
Yeah, I was going to say, of all the questions, the one that, it says, there's one that, can a company management do the 409A share evaluation, or do we need to hire an outside company? I was going to say, if you raise money or do anything like that, at least in my experience, and Zach or Ryan, feel free to interject, but it's always a third party that's agreed upon by the investor and by the startup. So like I said, that's what I've always seen. That seems to be common in regards to, again, my previous life doing venture, and now on the startup side. But I don't know, Zach or Ryan, if you know of anything different than that.
Yeah, I think once you are bringing in outside money, the important thing to remember as a founder is you have a fiduciary duty, right, to the investors, to the stockholders, and making sure that you have true independent opinion on really important things like stock price. It's good practice for sure. And typically, to John's point, it's going to be a requirement. So.
And then it looks like the next question is pretty technical as well. So again, we can save these questions and find answers. There's a question from Tony that says, should a startup use the services that are provided by banks such as Silicon Valley Bank or Bridge Bank to handle bookkeeping, etc.? That's a great question. Like I said, we're very, very familiar with Silicon Valley Bank. Worked with them for many years. And I do know, they have that kind of marketplace of services that they, provide. And I think honestly, it's just one of those things of figuring out what's best for you and your company. And that's not to be ambiguous. It's just, at other startups, I've used some of the services or some of the partners that they've offered or provided. And then for others, we just use them more for the banking side and, used other services that work better, for where we were at that point. But I don't know, Ryan or Zach, if you have any thoughts on that as well.
Yeah, I think it's just more of, it comes down to just ensuring that you have the strongest foundation possible. And is the solution that you're looking at. Is it scalable? Is it going to scale with you as the business grows? And then, you know, thinking about the analogy of, you know, how many times, you know, potentially would you have to pass the baton as you're going through the life cycle of your business? And the more you can condense or minimize that, I think probably the better, just from my perspective. So it's just being thoughtful and strategic about any solution, whether it's, you know, part of a SaaS offering, you know, part of your stack, you know, anything like that. Every single tool as a founder, you do have to think strategically about it. So hopefully that's helpful.
All right, so no more questions. I will, anyone has questions, please post them in the Q&A section so that we're able to, you know, get to them quickly. Oh, there is a question from Charles. I don't know if you saw that, John or Ryan or Zach. How do you balance
Let's see, it
your
says, how do you balance?
Go ahead.
Yeah. Just how do you balance a 409A valuation, which is to be extremely conservative, versus a push for higher valuation for seed to Series A objective done simultaneously? It's a good question.
That's a magical question. It's hard. That's probably the best way of answering it. Any type of balance to that of, you know, how do you know, justify a valuation from, you know, a venture fund in comparison to a 409A. It's, I don't know if there's a right answer to that, other than it's really difficult. And at the end of the day, as the founder, there's a lot of difficult decisions you have to make, right? And you know, seeing ahead of the curve is probably one of the most difficult skill sets any founder, you know, can try and obtain. It's hard to be predictive in the future as far as how is this going to impact us, you know, from an advantageous perspective or a disadvantage. You know, so you definitely have to take those case by case. I don't think there's really a good way to kind of blanket answer that. But John or Ryan, I don't know if you guys have thoughts, but.
Yeah, nothing more honestly on that. Like I said, it's just, again, it's an ambiguous answer, but it's true. It's hard, and it's a balancing act, and there's no magic answer. Unfortunately, there is. Looks like one more question, and this one we can answer. It's from Alan. So it says, how can a large company, low cash strapped startup, please be specific? Also, how can we be assured that we wouldn't be billed up with high hours because you get paid by revenues you generate? And how do we make sure you're not just passed off later to an underling who is not of sufficient experience? So I think that's an awesome question, a very fair question. Zach, do you want to kick that off first, or Ryan? Or
Yeah. I think, you know, from a pricing perspective, the way Spark functions, and I think also how we collaborate with KPMG as a whole, first and foremost is we leverage technology as much as possible to minimize or to help us really change the way that we price out some of the services. So Spark specifically, it's a simple subscription. So it's a simple monthly fee based on what services we provide. But also to what Ryan was talking about previously around R&D credit and around 409A, you know, we still try and leverage technology to minimize the fees as much as possible to stay competitive in the marketplace. But you also have a Big Four brand behind the work that's being done. So, you know, this is really what's exciting about what we're doing is, you know, we're able to reimagine, you know, what services we can provide to an early stage company.
Yeah.
And we're continuously working towards, you know, bringing new innovation to the market. And that's what we get to build on a daily basis. So it's a lot of fun.
And that's why I said, you know, to Zach's point, it's like, you know, for Spark, it's like, again, we aren't like a traditional big four, you know, it's not hourly. We don't bill hourly. All of our pricing is on launch point. So it's month to month. There's no contracts. You know, folks can cancel at any time. And again, to Zach's point, because we do leverage technology, that's how we're able to scale. I mean, as looking inwardly as a business, you know, that's how our margins and our KPIs are able to work, you know, but that's what's cool as well is because we leverage all of that, you know, for the price, you know, not only you get, you know, you're getting a KPMG, you know, bookkeeper, a team of bookkeepers and CPAs that you have access to at any time. And again, it's a new model that a lot of big four haven't leveraged, but again, based on the technology we've implemented internally, it's a model that works for us and it works really well, and it works really well for the startups we service. So it's been a great experience.
Yeah, and one thing I can say is again, the model, the way it works right now is if a company were to start with KPMG Spark, and let's say they're doing their bookkeeping, they're getting, you know, some tax advice and other services from Spark, those are going to be obviously priced considerably less than if you were to work with what we call the KPMG mothership, lovingly referred to as the KPMG mothership. But you know, the thing is as companies are progressing, there are going to be some issues that come up. So let's say you start doing sales internationally, or you know, you have some state and local tax issues that come up as you're going into different jurisdictions. Well, you're probably going to want to have a specialist that's going to jump in. And where KPMG Spark, that wouldn't be part of the core offerings of KPMG Spark, you know, KPMG proper in a local office. So let's say your company's based in Orange County. You know, we could get you connected to one of our professionals that is in Orange County that I work with on a daily basis, and they could figure out, you know, we could probably do a, you know, like a quick high level review of what the issue is, depending on how complex it is. We might be able to answer your question in a few minutes, and as a you know, as a client of KPMG Spark, it would be of no cost to you, right? To have that general, you know, high level conversation. If things do get more specific and you're tripping up some nexus issues in states, or you know, you might have some transfer pricing issues in another country, right? Some of these complex issues that do come up, then you probably would want to have some kind of consultation letter with KPMG, where you can reach out to some partner or MD and get answers that you need real time. So a couple things with that. One is, granted, you would probably be off of the KPMG Spark pricing at that point. But the second part of that is, you know, we have an emerging growth practice that I work in, and we price things right size fit for clients of your size. So with startups, we're not trying to gouge. We understand where companies are. And so, Alan, I hope this is, you know, answering your question the right way. And I'm trying to avoid generalities here, but you know, we would probably offer a discounted rate card that would meet your needs, and, you know, not be too exorbitant, because again, we understand where companies at this stage are, and we're not trying to. The other part of it is we don't want to oversell. So if there are you know, matters that come up, we want to make sure we're kind of delivering what you need rather than what we think you need.
Absolutely. Well said, Ryan.
Thank you.
I think that's all the questions we have for right now. So
there was one more. It was that I think we can answer. So if all the shares purchases have been by founders, family, and friends, can the share price paid by them be used to set the market value for stock options for employees? Will that satisfy the 409A rules? So I think it might be kind of confusing, two different things. So the 409A valuation is separate, right? Again, it's kind of an independent calculation versus what the share prices have been issued at. So I mean, you can issue shares, you know, to family and friends that are investing, and kind of, you know, do your own calculations there. But the 409A is meant for a separate calculation. And I think, again, that comes in when you have some third parties that you're trying to get involved. Zach and John, correct me if I'm wrong, but I would think that if you're going to a bank, again, to get some debt, or if you're thinking about bringing in some other external investors, that they would want this calculation to be completed. So it kind of sets that low end of the bar when you do this calculation.
Totally.
Okay. And then the question on the premium for preferred stock versus common stock, what's an appropriate range for the premium? That's a good question. I would have to think about if there's a premium on the pricing. I think the larger issue when it comes to preferred stock versus common stock is more just about the rights of what you're granted. If any of you have been to the TCA events, I mean, you'll see that whenever they're going out and raising around externally, preferred stock is obviously going to be preferred by the investors, and the rights that come along with that, the discount, the cap that's offered, protections against a down round. I think that's more important to the investors at that point. So I hope that answers that question. Again, the question on the capitalized product development costs, we'll take that offline and we'll get back to you on that one.
Cool.
All right. Were there anything else that came in that we might have missed, JJ or Stephen? I'm not seeing anything else.
I don't see anything else. All right, everyone, you could still, post your questions in the Q&A section. Makes it easier for us to track. So please do that while Ryan and Zach and John continue the presentation.
Awesome. So this next piece of this presentation, we wanted to focus in on the financials and what you should be thinking about as you're putting your deck together. So again, I keep coming back to Tech Coast Angels, but I think a lot of founders aspire to make it to that level where they can pitch in front of a great group of investors like that. They're super savvy. They see through everything, right? So you don't want to BS them by any means. But at the same time, they understand that, where a company is at that stage and what level of, of insights that you would even have to your business at that point. So the one thing we want to continue to stress and that you'll see in these next few slides is simplicity. We don't want you guys thinking that your financials need to be super elaborate because you looked at a deck from some company up in Silicon Valley. You don't want to project out too far. And really the reasons is because at this point, you don't have a lot of financial history, right? I mean, you've probably only got a few years under your belt at the most, likely a couple years. The revenues and costs have been kind of all over the place as you're figuring out your product, you're figuring out your sales channels, right? So it's, where do you start? So what are investors going to be looking for? We want to stress that, again, investors are looking for different things. So it's probably some homework you want to do, similar diligence that they're doing on you, you want to do on them prior to walking into that meeting to know what they're looking for. Again, you don't have to be a CPA or any kind of financial expert to put these numbers together. Although we do think that having proper bookkeeping is important. Again, you want to make sure that things are simple, that you understand them, and that you're not overcomplicating things at this point. Collect as much data as you do have, right? You want to be on top of whatever financial data is there and that you're generating. But again, the key is to limit your projections. You want to make sure you're only going out a year or two in the future. Beyond that would be a little too tough, and really you'd just be kind of making some really large assumptions at that point. Another key thing is you want to make sure that they understand where the money is going to go, right? So trying to divvy it up. If you're raising $1 million, is a quarter of it going to your staffing, and then another quarter going to software development. Maybe you're buying some hardware to put together what your next product's going to look like. Make sure they understand where that money is going. And then another key part is milestones, right? Everybody wants to see, hey, we're raising this money. It's going to get us 1.5 years of runway. Here are the milestones along the way that coincide with where we told you the money's going to go and what we're budgeting for. So that could be revenue generation, for sales. It could be you're going to reach profitability, a certain level of customers or users, kind of just keeping them up to speed with where things should go. Again, the more complexity that you add, the harder it's going to be to articulate. At this stage, you're not going to have the same amount of data as likely a Series B or Series C raise. So, don't try to overdo it at that point. again, we talked earlier with the 409As about basing the valuation of your company on market data and what you're seeing out there. So we would probably say the same thing would make sense for your projections. It's a lot more defensible in that sense, and you're probably going to get a lot more of an accurate take. So take a look at some of the pitch decks that are posted online. There's a ton of information that's out there. Get an investor or a perspective from a mentor or a peer, or some previous investors that you've had, somebody like JJ or another angel investor. I mean, that's literally what they're there for, right? I mean, there's a ton of value that they bring, and what you'll find is a lot of them love to talk. So, if you pick their brain, I'm sure they'll be much more than willing to share some old war stories with you and kind of give you that perspective. Obviously you want to define your business model, how you are going to make money. How does that kind of calculate? They're going to be keen on that. You'll hear a lot of that when you go to an angel network event, where they'll somebody will give a great presentation, and then the first question that comes up is, I don't understand your business. How are you making money? So make sure that comes out clearly, throughout your pitch, that, here's our business, here's how it's going to equate to money. Obviously growth potential is going to be very important for them. We're out here raising this money because we want to grow. Here's where the money's going to go. So kind of, to that last point that we're making on the last slide. And then, if you are lucky enough or fortunate enough to have some really good projections that you can make, because your company might be a little bit further along, or your revenue's a lot more consistent, maybe use an appendix. You don't have to bore everybody with a ton of the details. If they're really interested, then that'll all come out in the diligence process. But if you do have it there, you can put it in the appendix. They can take a look at it at their leisure. But really in that 10 or 15 minutes that you're going to have to pitch to them to start, let's say at an angel event, you're not going to want to put all of that info right up front. Again, you want to be clean and crisp, maybe a simple graphic to give them an understanding of what that looks like. And we'll show a little bit the next couple of slides. Clean and crisp, you can see how much content I have on this slide. This is probably even overkill. Large graphics. And again, it's not because they're simple-minded, it's just because people these days have a limited attention span. So keep things short and sweet, right? So here's a snapshot of what your growth projection could look like, what the user base looks like, maybe your revenue run rate and kind of like top line projections, margins, what retention would look like. So just again, keeping it simple. And we've all seen this graph, and this is exactly what investors do want to see. Here's a simple, again, profit forecast. It shows what your revenue and cost drivers look like, what your valuation looks like with EBITDA calculations, calculations for taxes, if that's going to be the case, and then net income. So if you can project out in a couple of years and show profitability, I think that's great. Even if you are eventually going to be running, or if you're going to be running at a loss for a few years, I don't think a lot of investors care as much about that these days. It seems like that is changing a little bit more. That sentiment is changing, where profitability is becoming more important. But I think if you're showing that gap is closing over time, that could be good enough to satisfy what investors are looking for. One thing to keep in mind with this snapshot is I'm showing a company that has hardware and software. I know some companies aren't limited to just one revenue stream over the other. So that is something to keep in mind, that you want to show all of your revenue drivers if you can. So what do your key metrics look like? These are some of the ones that we've pulled. Again, these seem a little bit more focused on what software companies might be considering, but revenue per employee is an important number to keep in mind, right? As you're adding headcount, how is that going to potentially drive what your revenue looks like? Churn, are you keeping, are you losing customers? One thing to keep in mind is that not all churn is bad, right? You might be churning out some customers that were paying a lot less when they started and bringing on customers that are going to be paying more. So, net, you might be actually in a positive despite having some churn. So keep that in mind. CAC and LTV, obviously, we hear about these all day long. And acquiring customers is the most important thing that you're going to be doing, but at what cost? And then your lifetime value of a customer, something else to keep in mind, right? It's a critical number. You're able to show and kind of defend, hey, here's how much we're spending, but here's how much we're getting out of a customer once we're bringing them on board. Let me pause here and see if there's any questions. Nothing there. John and Zach, any thoughts here?
I mean, another interesting one, thinking about CAC and LTV is the LTV to CAC ratio, and combining those two metrics, and it'll actually tell you if you should be spending more on acquiring more customers, so increasing your ad spend. Ideally, it should be like a 3-to-1. So your lifetime ratio should be 3 to 1 on CAC. So that's an interesting one to combine and look at to help you think about driving additional customer acquisition, and if you should increase, your efforts there.
All right. I think there's a question.
Yeah, just saw that. So
I have a quick question on that. Sorry, I didn't see that question, but my quick question on this is, for the LTV, you have to have some historic data. If you only have 3-4 customers, that may not be enough, right?
Yeah, sample size is always important for sure.
Yeah, okay.
So it is tough, but if that's all you have, I guess 3 or 4 is better than
nothing.
Yeah. And the other part of it again is if you can find some historical data, some industry data to understand, here's what a similar company was doing, then maybe that could be something that you could present as well.
Okay, all right.
Fair enough, JJ?
Yeah, that's fair enough. Because you know what, Ryan, you and I mean, we sit in those TCA meetings, and then I got a guy and he has only 1 customer. And then he says, our LTV is, and I was like, how did you come up with the LTV? Like, okay, maybe you have 20, 30 customers, I get it, but 1 or 2, you're not gonna get enough info. So
that's a little rough.
yeah.
It's literally the lifetime of that guy. If your customer has some issues, and
it's probably his cousin too. So there you go.
That's funny.
Okay, another question that came in: is it better to have customers pay a monthly subscription or a fee per use?
That's probably more of a business question than a KPMG question.
That's a tough
one.
I
think it depends. Yeah, I think it depends on your business model, for sure. Because if it's something that you can kind of drive down with scale, I mean, that's going to definitely drive how you're going to price this out.
And it's hard to beat reoccurring revenue, the consistency, and that's a bias from my perspective. Sure.
That's definitely the KPMG Spark model, right?
Yeah, exactly. Subscription model.
Yep. And I think investors these days really do enjoy the recurring revenue models. That's something that's definitely preferred these days.
Yeah, definitely.
All right, let's close that one up. All right, guys, just a couple more slides to run through. So some other considerations, obviously, to keep in mind. You want to know your head count. To JJ's point, you want to know how many users and customers that you have as well. So your cash flow, how quickly are you guys burning cash? That's critical to understanding how much run rate you have, or how much runway you have left for the company. In your financials, that should be very evident, or very clearly evident. Your CapEx, have you purchased any large equipment or hardware? Is that going to be necessary for you? Multiple revenue streams. Again, are you selling hardware and software? Do you have initial startup fees and also subscription services? Something that you need to be able to illustrate in your financials. And then a break-even point. Again, if you can project out to show that, or at least show that you're getting closer to that point, I think that's a critical milestone for companies to understand. So some things that we like to say not to do. you know, if you're telling them this is a conservative estimate, you know, again, this isn't a budget at that point. I mean, you want to be optimistic about what the company's going to do. If you're telling them the company's not going to do as well, you're probably not going to be able to raise as much money out the gate. You know, again, limiting yourself to, we're only going to get 1 to 5% of the market. Again, I think, you know, I think it's better to just kind of show what the overall market looks like, and, you know, kind of let the investor figure that part out on their own. Again, you don't want to project out too far at this stage. It's too early. Maybe show, you know, 2-3 years max at that point. And that again depends on how much history that you already have, right? You can't really project too far out if you don't have enough history to do so. You know, don't lie, obviously. And then again, as you're going through the process, you're going to be meeting with a ton of investors. You're going to be getting a ton of advice. You know, take it all. Even if you don't get you don't get somebody to invest in you, but they gave you a bit of advice. Make sure your deck and what the you know, what your projections look like and all that is going to be evolving over time. So don't be afraid to take that advice. And then again, the other thing is, you know, these investors are investing in you, right? So you want to make sure that you come off as confident, that you are obviously invested in your business yourself, that you understand your market, you understand your product, and that, you know, how passionate you are in your business. Something that we always hear is this guy coachable? You know, is this founder, is she someone that's going to take advice? And that's something that comes out more clearly, or it's more preferable, I would think, to investors to understand that, hey, this guy's got this product, this gal, she has this great idea. You know, can she make it across the line? Can she take it to that next level? And so making sure that, again, you're passionate, but that you would be willing to work with that investor, and take some guidance along the way is definitely critical. Some final takeaways for you. So again, no perfect deck. I think I had some typos in here as well, but no. Again, it's not going to be perfect. Your pitch isn't going to be perfect. You know, learn each time you're going through it. You know, take a leap of faith. Make sure you're you know, kind of enjoying the process. You're not building a budget that's going to be monitored by anybody. You know, everybody understands that things are going to be evolving. And again, just be passionate about your product. You're selling yourself as much as you are this great company that you've built. So on behalf of you know, John, Zach, and I, we definitely want to, you know, thank you guys for the time this morning. Again, if you have any questions, feel free to reach out to us directly. I think we've got a couple more minutes here that we can spend with you guys. But John and Zach, if you guys have any final thoughts?
No, I think, yeah, that was an awesome summary. I think, you know, just as hopefully some kind of capstone, it's just, as a founder, the journey can be hard and long, but it doesn't have to be lonely, right? It comes down to just be cognizant of the team that you're building around you and your company. And just let your passion come through, and that does amazing things for a lot of startups. So, you know, we're ourselves very passionate and excited about the startups we interact with, and if there's anything that we can support you guys, whether you sign up for Spark or not, we still want to be part of the startup community and supporting as many people as we can. So just to appreciate the opportunity to come and talk, and hopefully be helpful in some shape or form. So thank you guys.
Well, thanks, Jack, Zach, I'm sorry, and Ryan and John. Great presentation. I learned a few things. I love that LTV formula, so that's a good one. All right, anyone with a question, final thoughts? Either if you want to ask a question via audio, just raise your hand and I'll bring you in so you can ask the question. So you're welcome to do so. Or you can type your question still there. While we're waiting for any questions, I'll remind you that we have a virtual networking time right afterwards. again, grab the link and the password from the chat. Stephen just posted that a second ago. We have, so this will follow, the virtual networking will follow immediately the end of this webinar. Just to remind everyone, it's probably better to use Chrome, or for some reason you can use the desktop or app for, it's called Hio Social. So you can download the app on your iPhone or a smartphone, Android, etc., or you can use the link directly on your desktop or laptop. Best to use a Chrome. If you haven't registered for Hio before, all you have to do is put your phone number, and then you'll get a text back and you'll be able to log in. You still need the password that we posted here. Okay, we have a question to be from Amit. So I'm going to bring Amit in. There we go. Go ahead, unmute Amit, and you can start asking a question.
Hello, can you hear me?
Yes.
Yes.
Hey, Amit.
Hi, thank you very much today for giving this session. My apologies, I missed some part of it. I was stuck. I always appreciate Mr. JJ Richa's all these sessions. They are very informative, very, very informative. So just a simple question, and I'm pretty sure you have already covered that up, and I can follow up later if it is going to waste time. How to get stock issued for the company? And the reason I'm asking is because startup, right? I cannot pay money to all the people I'm working with, but I do want to get them something so they get invested in and they are more passionate and committed. So how to get this stock issuance for the company? These are the things I don't know much about.
It's a really good question for sure, and really important. And Ryan, feel free to elaborate. But I would think some of the first steps is engaging with legal counsel, making sure that you have that side of the process covered from a transactional standpoint, and then really considering a 409A, some kind of valuation technique, a formal one, an independent one, but depending on what stage you're in too. I mean, there's a lot of aspects there. But Ryan or John, I don't know if you guys want to touch on, sprinkle any more knowledge on that.
Yeah, I would say just as you're kind of starting the startup, you're going to want to have a kind of a pool of shares, however many shares of stock that you want to have. Let's say it's 10 million or a million, whatever whatever the number that you come up with. But to Zach's point, I would think that you would want to pose that question to legal counsel when you're forming the company, and then as you're going through each round of funding, you'll bring them in to have those conversations about how many stocks you're going to issue. And the good thing about lawyers is you can probably get deferred fees with them as they see some potential in your business. So it isn't as cost prohibitive to start up with them if they do see potential in your business.
Yeah, I would say that's more of a legal question than an accounting question. But yes, you could, when you start a company, you could, depending if it's an LLC or whatever, you can have as many shares as you want. You could say, I'm gonna have 1 million shares, and then you issue shares to yourself and to your team as part of that. That's usually how it works. And so you have outstanding shares and you have issued shares, and you have and then later, depending, like Zach said, depending on what stage in your company you are, then you're going to have different valuations for these shares, from a penny first to dollars to tens of dollars to hundreds of dollars down the road. But it is more, for issuing shares, I would say it is definitely a legal question. We all here probably would be just give you not exactly the right advice. That's not our strength. All right, anyone else?
Sure. Thank you.
Yeah, no problem. Thank you. All right,
Looks like-
Randy Coonan, he posted a question.
Why don't we hear from Randy? This way. not
Randy, you
having
wanna
our boring
come,
voices.
come live? Raise your hand for me, Randy, and I'll bring you on live for a quick question. All right, here we go. Go for it. Unmute Randy and go ahead.
Hi, my question more formulates around the starting of a company, particularly with the demo unit or the MVP. As I heard you today, it sounds like those are R&D expenses that could be tax deductible. But does it matter what stage you are, whether you're as an individual or whether you're a C corporation, when you would want to apply those? So if, is there a better time to wait to apply those particular expenses?
In terms of timing, Zach, would you have any perspective on that? Like if it makes more sense?
Yeah. See
Later?
what's really cool about that is, so I did it retrospectively, but that created some other issues as far as needing to amend some tax returns, which sucked. So the good thing is if you track it now, you can carry those forward. So that's the advantage of doing it early. It means you're not going to have to go back and amend tax returns, which is it can be costly and just a hassle. And then if you're amending tax returns, it could potentially open up other issues with the IRS. But so if you do it early and you plan ahead, you can at least carry those credits forward. So there's other benefits there too.
Yeah, and if you're a corporation, you can claim the R&D credits. So I think that was the other part of the question that Randy had in his typed question, at least.
All right, any other questions, Randy?
No, thank you.
Thanks, Randy. All right, anyone else? Okay, if there are no more questions, again, Ryan, Zach, and John, thank you very much. Really appreciate the insight today. A lot of great information. If you don't mind, Ryan, if you could send me a copy of this, because usually everyone asks for a copy, so we can send it out to the participants. All right, thank you guys very much. If you can join us, also grab the link and the password. If you can join us on the HIO, it would be great. Usually we get a bunch of people there asking more questions, so that might be useful as well.
Cool. Thank you
All
all
right.
so much.
So,
Talk
thanks, everyone.
to you soon. Yep. See you on the other side.
See ya.
Bye.